So that's I will be doing. I'm just actually starting the recording. Okay. So to start with this session, this is I repeatedly saying in my emails also that a lot of people were asking me which share we should buy, which share we should actually sell. This is the lifetime opportunity to have some investment on the stock as well. But at the same time, so people get excited when they see the price are going down. They try to buy stocks and sell the stocks, and they may actually lose their money as well. So that's why I devised this small webinar just to show the basic fundamentals of the investing. So I'm actually repeating the objective of this session is not to discuss which share we should buy, when to sell, and when to buy. But this is the fundamentals of understanding the health of the company, so where you should be investing. So, stock trading and investing. So, I have a couple of questions. I'm just actually opening uh, this polling with you guys. So, please respond. The poll will be open for two minutes. I will be quiet for that time. So just look at the polls, just answer the questions, and then we can respond from there. Here you go. This is the 2 minutes polling for you guys. So my first question was, do you have any experience? So I can see. mm,
Sorry, I don't see any question.
oh, I shared. I think majority of you guys are seeing and they are responding. Okay. Uh, Why don't you see? Because guys are responding. They have this.
You have to look at your taskbar and click it. Look at your chat actually and see that there.
Can you explain question number 3?
Question number 3. I'll be explaining during this session, but I just ask if you know these terms, it means you know that. If you don't know, that's okay. It means you don't know these two terms. That's okay for that. So you can just ignore that question if you don't know these two terms. Then I will explain this. So I'm just waiting for the results. Okay. So 60% of the participants has almost no experience of stock trading, and few are here who has a good experience, like 10 years. That's good. And second question I had, I'm sharing the poll result also with you guys. If you guys can see that, if not, that's okay. So second question was, do you know the difference between the trading and investing? So it's a 50-50. So 50% people know that what's the difference of trading and investing, and 50% don't know. And the third question was the swing trader. So I see that 50% of the guys are swing trader, and only few guys have a day trader. So let me explain you the question. So first question was very simple. The second was the difference between the trading and investing. So trading means when you are buying a share and selling it in next few days. It may be the same day, it may be a month or 2 months or maybe few months. But the investing is when you see a company, you buy the shares and you hold it for years. So that is kind of investing. You are getting the dividend every year, and you're just keeping those stocks with you, and you can sell them, but it's a long-term buy or sell. That is the difference between the investing and trading, and we will be discussing today regarding investing. I'll see if I might be able to schedule some for the tradings, which belongs to the technicals. So when we talk about the company's health, we talk about the fundamental. This is called fundamental, which means what basically company's health is. So how strong the company's earnings are, how strong the company's assets are, how strong the company's management is. So that is the uh, company's strength and health. And you see the company's strength, and then you buy which company's stocks you want to buy. That is the investing. And trading, you don't care the company's strength, you just care how the stocks are being moved. Either it's a buy stock or sell stock. You buy the stock, and when there is a good time, you sell the stocks, you get your profit, and you're out. So that is called trading. And during the trading, uh, there is few terms in the trading. So day trader
Hello.
means, yeah. Hello. Okay. So day trading means you are buying the stock in the morning and you are selling before the day end. So you are getting some profit, but 80% day traders normally end up in losing their money. And swing trade is when stocks are up. When stocks are down, you buy these stocks, and when they go on the peak, you sell these stocks, and when they are going down at the bottom, you buy again. At the peak, you sell again. So you go with the up and down trend. Not It's not day trading. Sometimes it takes more than months. So this is called swing trade, and this is and day trade. So we will not be discussing these, but I was just checking if you guys know that. So let's start our session from here. So I'm just repeating for the new guys. If you have any question, you can actually text me in the chat, and I'll come back to you. Today's focus. Somebody asked me if this is the today's session is trading or investing. So we will be discussing investing. So we will be discussing what are the assets, liabilities, small business model, and what the worth of this stock, what is the fear and greed cycle, what is the undervalued stocks, and I will be sharing the Warner Buffett's 4 rules, and I will share some PDF in the emails to you guys after the program, and that's what we will be discussing. So let's talk about something about assets. So I'll be doing another polling. In few seconds, please. So I just open another question to you guys. If you have a car, is it your asset or liability?
Liability.
You just answer the poll. You don't need to speak about that. Let's see. I'm just waiting for the answers. It's coming up. So 30 or around 60% people are saying around 60% of people are saying this is asset. You might be able to see the results. But the simple formula for asset and liability is if something is coming to your pocket is your asset, and if something getting out of your pocket is your liability. So generally, when you have a car, it just take money from your pocket. It's your liability. So you are actually paying for the maintenance, you are paying for the petrol, you are paying for the lease. It's all money going out from your pocket. But if you have a car and you are using this for Uber or you are using this for a rental purpose, then this is your asset because it's coming, money is coming to your pocket. In the same way, if you have a house on the mortgage and you are paying mortgage, you are paying the bills, you are paying utilities, everything. So it is not your asset; it's your liability until unless you sell it and you have money in your pocket. But if you have a rental property and it's giving you money, that is your asset because it's increasing your equity. That is the simple formula logic. People may have a different perception, but generally, if money is coming to your pocket, that is your asset. If something is taking money out of your pocket, this is your liability. It's a general simple thumb rule. So what people normally does, they try to focus how to increase the money into their pocket, towards their pocket, and how to reduce the money going out from their pocket. That's how people actually should behave. So regarding the stock investment, I will be taking yes, cars are depreciated. So that is also devaluing your asset. The people are actually commenting on the text box, so I'm responding those two. So let's take a small model to understand the stock investment business. So let's say there is an owner, they have a small ice cream business and there are customers. That's the three elements we have for our business. So the small ice cream shop, they are selling the ice creams and there are customers. They are spending all the customers within 1 hour. I'm taking example. Within 1 hour, they all are, let me see, I think. Okay. I'm just checking the chat box also. Yes, that's good. So if all the customers are spending $100 in 1 hour, so how would you split this money into your costs? So you have let's say you have a $20 per hour employee, and you have a cost of making the ice cream, which includes the materials and the machines, everything, for $40, and you have rent of the space, which is $10 per hour. So whatever the monthly rent is, if you divide this on the hour basis, so let's say you have a $10, so it means the cost of the revenue is $70. So what this owner is getting, so she's getting $30 before the taxes. So if we pay $10 tax, so she has $20 now. This is the money, net income or earning she has from that business per hour. So what she can do with this this $20, either she can take as a dividend, or she might be able to buy some more assets to increase the equity. So she might use this money, or maybe portion of this money, to buy more machine or some more material for the ice cream, and she might actually use all for the equity, or she might use all for the dividend. That would be her call. Thank you. So let's start doing this evaluation. So let's say if we take the same example, like 1 hour, she's revenue is $100, and if we actually take an example in the bigger scale for 1 year, so in 1 year we assume that there is a revenue of $100,000, and with the same ratio, the cost of the revenue is 70 grants. 20,000 goes to employee, 40 for the cost of the ice cream material, and the rent is 10,000, and she's getting 30,000, and 10,000 are tax, and 20,000 is the net income per annum. So you can respond in my email. What would be, if you have to buy this business, how much you can pay for to buy this business? You can respond on the text box. Just any numbers. If this owner, let's say she's Nancy, so if she's selling the business, how much you would like to pay to buy this business? Somebody's saying 60,000, somebody's saying 70. Yeah, that's a close number. So let's see if she's selling this business for 100,000. It means the rate of return for you would be, if you can't hear me, probably there is something you have to check with your speaker. I think everybody is hearing me. So if 100,000, if you are buying 100,000, the rate of return is 20. It means you will get your investment back in 5 years almost. If you are buying for 200,000, it means your rate of return is 10%. And if you are buying for 400,000, your rate of return is 5%. That's the simple math. No rocket science. But what is implied here? If I will be coming back, what is the risk at what value, and if this is worth at what value this business worth to buy. So we have to talk about the balance sheet. So there is a yes, we will be talking at what price we should be buying. So if this is 70, you can divide 20 by 70 and you will get the rate of return, and you will see how much I think for 70 it is almost 3.5 years to get your money back. So if she set the market price of 200,000, how safe the investment would be, we have to check her balance sheet. So we need to understand the balance sheet. So for any business, there are three documents which are very important. One is the income statement, which shows what company is earning per share, what is the net income, what are the revenues. The balance sheet, which shows what are the equity of that business, how many assets they have, what liability they have, and the cash flow means how they are managing the cash for day-to-day activities. So let's talk about the balance sheet. So balance sheet is simply the difference between the assets and the liability. It shows you the asset, how many assets you have, the business has, and how much liability they have. If you take liability out from the asset, you take the difference, this is the equity of that business. So this is the current worth of that business. It means if we have to liquidate a business today, what is the equity? So keep in mind, she's asking 200,000 for the business. So this is the breakup of the balance sheet. A simpler version of the balance sheet. You will find lot more complex balance sheets, but this is the simplest version. She has the cash in account 3,000. Ice cream stand is 10,000 worth. Ice cream machine is 5,000 worth. Supplies are 1,000, and land, the area where this ice cream stand is built, is worth of 25,000. What are the liabilities now? She owes a salary of 2,000. Ice cream stand, she still have to pay 9,000. The total worth of the ice cream stand is 10,000. She is leasing. These are the somebody asks if this is the depreciated numbers. The balance sheet, whenever you look at the balance sheet, this is the current numbers. So every month companies issues their balance sheets, income statements, or some companies actually do annually. So this is all the current versions. So when we talk about ice cream stand, so they are this owner has 9,000 still in the liability. It means they have to pay, and the total worth was 10. The ice cream machine is still they have to pay 3,000. The total worth was 5,000, and land they still have to pay 23,000, and they still have to pay 23,000. The worth was 25. So if you take the difference, total assets were 44,000, and total liability is 37,000. So worth or equity right now the company has is 7,000. So you can check your personal equity anytime. Just check your whatever the money and in assets you have, and minus your liability. For example, if you have a house of 400,000 worth, and you paid your mortgage of around 100,000, and you still have to pay 3,000, so your equity is 100,000. So similarly, you can add your values and you can actually calculate what is your personal equity at any time. You can do whenever you want to do, every year or monthly basis. Yeah, depreciation is already inbuilt in these numbers because ice cream stand is renting. So depreciation will be adding up in your income statement. So balance sheet is covering is different total assets and liabilities. So if Nancy, let's say name of this owner is Nancy. If Nancy couldn't find a buyer, how much is her business worth? She wants 200,000 for the company. That is only 7,000 equity. This is the difference between the market price and the real worth or equity is the risk. How much risk a buyer gonna take? So closer the equity to the market price, the safer the investment is. So how we will be calculating this? So in the income statement, we have 20,000. This is simplest versions. We have 20,000 per annum, which the rate of return is 10,000. And if she is talking about 200,000, the value, and balance sheet is showing 7,000 as an equity, the safety we will be calculating in next slides. So this is, let's say the balance sheet is, and this is the style of the management. If you have a good management, they try to use the dividend or earnings in a split form. They take some dividend and they invest some again to buy more opportunities or assets for the company. So the management need to look at the equity increase also. So we will be talking this also, how the company should look like. So this is the simple business model, how you have to see the balance sheet of a company, how to assess the equity of the company. So we are not talking about the assets, we are talking about the combination of assets and liability. This becomes the equity of a company. So this term is very important when you are assessing to invest in a company for a long-term purpose. When I say long-term, you're buying share and you are putting in your RRSP and you are getting your dividends, and price are also, market price of shares are going up and down, but you are taking your dividends, making some money on that. So what is the share? So if Nancy could not find a buyer, and what she can do, she can split her business into small pieces. So Nancy's business value, she changed her business worth, and her business value is 100,000, and she said, okay, she would be able to split in 10,000 shares. So worth of each share is $10. If you divide 100,000 by 10, is a simple. This is called the book value, and I will show you live on the screen how to see the book value of a stock. So earning per share. Now we are coming to start evaluating the company's health and as per the shares. So whatever the company is earning, so for example, if on a whole business she earned 20,000 per annum, equity is 7,000, and market price is 100,000. So this is the per annum income. So if we divide this per stock, so if we have divided 100,000 into 10,000 stocks, so per share value is $10, and we can divide with the same ratio the earnings also. So it means the earning, if we divide this by 10,000 as well, so we are getting $2 per stock per share per annum. This is called earning per share, and you will find this in the financials of any company, earning per share. So how much they are paying per annum per share. And book value. Book value is when you divide the market price with the equity, market price of that business or stocks with the equity. This is your book value where you are starting. So book value change every month, every year. So because it depends on your market value, and divided by your equity. So this is your book value. So for right now, the current book value per share for Nancy's ice cream business is 0.7. If you divide 7,000 by 10,000. Market price you can't determine, and we will be talking how the market price is set. So in the next stage we will see that. So price earning ratio is typo. In the share terminologies, if we see the total number of shares are 10,000 and $10 per share, this is earning. That's the same thing which we are talking about. And price per earning. So what is the price per earning? The market price of the share is $10 and earning per share is $2. So price per share is $5. Its ratio is 5. So this is the important ratio. We need to keep an eye on this one, and I will be elaborating in next couple of more slides. So if your market price is 10, stock price is 10, and your EPS, earning per share, is $2, then your ratio price per earning is 5. What does it mean? The 5 means every dollar you are spending in the stock, I should receive $1 in a profit per annum. So $5 which I'm spending on the stock, every year I should be earning, I should receive $1 as a profit per annum. That is how it represents. So $1 you will be earning for every $5 you are investing. So just imagine if you are investing $5 for $1 or you are investing $2 for $1. That's how you calculate, you look at the price to earn ratio. And we will be discussing a little bit more detail these ratios. So let's talk about this ice cream business. So net income per annum is 20,000, market price is 100,000, and we are expecting return per year is 20%. Same thing is applied to a smaller level per share. So these are the basic fundamentals, basic to understand the business earning per share. I would be sharing this. I would send this to you guys as a PDF. Can you show again how? Okay. What was the question? Let me see. Can you show how to calculate a share price? A share price you can calculate by dividing the book value with the total number of shares. That's how you calculate the share price. The total number of share you divide. What is the PE for the ice cream? Ice cream PE is 5. So we are saying 100,000 as a market price. Although she was talking 200,000, she was expecting 200,000, but market price set is 100,000. So if we divide with the ratio with the business to generate the shares, so earning per share is $5 or 5. That's what we were asking. So we'll see that in the next level. So this is the Warner Buffett's 4 basic rules, and I would actually send you one pager where Warner Buffett used 4 basic rules to buy any stock. First is a stock must be stable and understandable, and we will be talking all these rules in detail further. So don't ask me details for these. We will be discussing this. A stock must have a long-term prospects. A stock must be managed by leaders, and a stock must be undervalued before you buy them. But keep in mind, even Warren Buffett, he loses money in the stock market. He makes the money, but he also loses the money. So there is nothing final word for stock market. Okay, this is the word, and you will be definitely getting money. But there are some principles which we need to follow. So we will be discussing the first three rules, but let's talk about the fourth rule first, because we are discussing this earning per ratios and these terms right now. So market price, we are actually taking our example of Nancy's business. The market price of that Nancy business is $10 shares per share, the $10. Earnings are $2 and book value is 0.7. And how did we calculate the book value? Book value is the market worth of the business divided by the equity total equity divided by the total share. So this is the book value. So if you see, the market price is 10, but book value is 0.7. The difference between the market value and the book value is the risk element. So I would say, before going further calculation, my if you can see that the stock value, equity, somebody asked a question, he's getting confused with the equity and the market price. So equity is what you have the difference between in your balance sheet for the assets and the liability. But market price is, if I like that share and I can buy for $2, it's my choice. So the share price of your stock is $2, even though it's worth for 70 cents. But since I have some money, I want to invest, and I see that your stock price will go at 10, I can buy in 2. So this is the market price which is set by the people. So we will be coming to that. So hold to that question. This is very good question. Hold to that one. We will be actually responding this in next few slides. So let's see the price to earn ratio for Nancy's business. So $10 stock market price and $2 earning. So price per share earning is 5, the ratio, which is the 20% return. So if we actually do calculate the returns, then if your price to earning ratio increases, it means your rate of return decreases. So for 5, your rate of return is 20%, which means you will be getting your investment back in 5 years. If your price to earning ratio is 10, which means either, I'm going slow here to understand because people may get confused with the numbers. So for example, if the market worth of the stock is 20 and the earning is still $2 per share, so your rate of return will go to 10%, which means now you will get your money back in 10 years, not 5 years. So if your PE ratio goes further to 15, it means your rate of return is now 6%, which means you will get your return back in more than 30 years probably, and so on and so forth. So if your price to earning ratio increases, your rate of return decreases. So ideal would be price to earning ratio. Ideal would be 1. So it means whatever you have invested, the same is your earning per annum. So within 1 year, you will get your money back. So which is not very practical, but I'm just actually giving you benchmark. If it is ratio is 1, it means you will get your return back on the same year, and in the future year you are just getting your profits. So that's how you should see the price to earning ratio from your investing point of view. And another ratio is here, price to your book value. So book value, market price is 10, and your book value of this share is 0.7, 70 cents. As I did mention to you, book value is being calculated dividing your equity by total shares. So this is the ground reality, that this is the basic value of that company, but market price is $10. So if you divide the market price with your book value, you get another ratio, which is called price to book value ratio. And I will show you in the stock market, every company shows that these ratios in their balance sheets and financials. So the ratio is 14.3. It means $14.3 you are paying to earn $1 for the book value. So if you're, what is a good book? There is nothing good or bad. So please hold this question for the next slide is coming, and it will give you the Warner Buffett rule, how to see, how to evaluate. So if your price to book value increases, your safety margin decreases. What is your safety margin? If your price to earning ratio, price to book value is 0.7, so which means if I see here, which means if it is less than 1, like 0.7, it means your market value is less than your book value, correct? If your numerator is greater than your denominator, then you are getting the number less than 1. It means your price value is less than, market price is less than your book value. For example, for this 0.7, it might be 0.6, might be 0.6 is your market value, and your book value is 0.7. So you will be getting a ratio like this. So it means your investment is 143% safer. So when price will come back to the book value, you will be making profit. And if it goes above the book value, which is generally the trend, no company stock you will be finding on the book value. But you have to see how far it is from the book value. So if your book value and price is same, then your safety is 100%. It means if this stock is market price is 0.7 and book value is 0.7, then your safety is 100%. It means the price will most likely will go up and you will be starting making money. So the fundamental is price to book value ratio increases, your safety margin decreases. So it means you should have lower value of the price to book value. I'll be skipping this slide, but this is the Warner Buffett calculation. So you may want to note this down somewhere. So Warner Buffett says you should buy the stock which has the price to earning ratio less than 15 and price to book value ratio less than 1.5. But in some cases, you may have a company who has a price to earning ratio 13, but the price to book value is 2 or 1.8. So what you should do? Then the Warner Buffett said you can multiply them together. The total should be less than 22.5. For any company, if you calculate this, you will find these numbers, and I will show you. You will find these numbers in their financials, and you can always multiply them and you can get the number and you can see if this is less than 22.5 or it is more than 22.5. Any question on this one? So price to earning ratio should be less than 15. If I go back to see to calculate the price to earn ratio, so whatever the market price is and whatever the earnings are, this is the price to earning ratio. So Warren Buffett said you should buy the stocks which has less than 15 price to earning ratio. It means your rate of return is in the reasonable range. So price to book value, market price divided by the book value, and book value is being calculated total equity divided by number of stocks. This is your book value. So ratio between the market price and book value should be less than 1.5. So if you find a stock which has 2 as a PBV and which has 5 in the PE, then what you would do? So here Warren Buffett suggests you can multiply those together, and if you find total product less than 22.5, then this is the good company to invest. Yes, these numbers are very easily available on the company's financial. So say somebody asked me what is the safety part. So it means if you have let's say if you have the book value of a company stock 0.7 and the market price of the same is 0.7, so it means your safety margin is 100%. It means you are buying the stock on its book value, so it probably will not go below the book value, because book value is what is your real worth on ground physically in reality. So probably stock will not go below the book value, so you are almost 100% safe. And most probably the book value market price will go up from the book value. Yes, you're right. So in the Nancy case, the price and earning ratio, book value may, somebody asked me the question, will the book value remain same? No, because book value is you divide your equity by number of shares. So if you don't know, the companies actually change their number of shares. Sometimes they split the shares. For example, initially they started with the 100,000 shares, and now they are saying they are splitting the stock 1 into 2. It means their total stock will be 200,000 now, but their equity is still the same. So if you divide the same dollar amount equity by the stock now, your book value go down. And similarly, you have the same number of stocks, but the management buy more stock, more assets, more companies, the mergers. So their equity value will go up, keeping the stock same, the shares, number of shares same, then the book value will change. So book value is not a constant number, it changes. And in the company financials, if I show you briefly, I normally use some websites. There is you can always Google stock screener. You can always Google stock screener. Can you see my screen? This one. Let me show you. Okay, I'm sharing a screen now. Probably you will be able to see now. So if you search in the Google stock screener, you will find many websites. So what does it do? If you want to, for example, I use the cainvesting.com stock screener sometime. If you want to see companies who has, you see the price to earning ratio, can you see that? So if you actually go on your screen, I'll give you 2 minutes, but just look at my screen first. I will give you 2 minutes to just do some browsing to understand. So you can always type this. I'm sharing this address in your chat box. So you can just actually copy and click. And the other one, which I normally use, MSN Money. So I'm sharing that one too with you guys. So in the stock screener, if you click the PE ratio, price to earning ratio, and I want to see all the companies who has the price to earning ratio, what Warner Buffett said. I think I should actually start sharing my desktop. So whatever I will be doing, screen, okay. So what Warner Buffett is saying, price to earning ratio should be less than 15. So if I go back to this stock screener, I can say, okay, show me all the companies which has price to earning ratio 10, 13. Okay. When I do that, it sorts all the company. These are the company as of today, they have the price to earning ratio 13 or less. You can filter from here which stock exchange you want to search on, then you can find the companies. And also earning per share. If you want to see what earning per share you are looking for, let's say you are saying earning per share should be $2. So now they will be showing you the companies which has the price to earning ratio 13 and earning per share is 2. Yes. The ratio, lesser ratio is best. So this is the stock screener, how you can find which companies falls with your required criteria. So these are the companies you can go and search them and check if they worth to buy. So this is one step. So if you see here in the MSN Money, if, for example, I search ExxonMobil. So if you see here financials, it shows you income statement, balance sheet, cash flows, and if you click on the analysis, it shows you the ratios, price ratios. So it shows you uh, price to book value as well. So this is what we were talking about, price to book value. Okay. So we will discuss this. So let's say price to book value for this, and you can calculate price to book value by yourself. So what you have to do, if I go to the summary, it says not summary. Sorry, I should go to the balance sheet. So if I go to the financials, you guys can see my screen, correct? Okay, great. So in the balance sheet, if I go here, you see here, no, it's not balance sheet. Balance sheet is here. So if I in the balance sheet, if I go down towards the bottom, you see number of shares. So somebody asked me if the book value will remain same. So see, in 2016, the ExxonMobil has around 4,000 billion stocks, shares, and they increased. So now they have 4.2 billion shares, and their total equity is here. See this line? Total equity is this. So if you divide total equity by the shares, you will get the book value, which you can see in the summary sheet here. So book value is in the ratios. So you see the book value is 0.95. Now you will be surprised that book value is 0.95, but the stock is being traded at 43. So that's okay. This is the market price. So you have that is why you have the ratios to see when to invest and where to invest. So I'm going back to these slides, and we'll come back to these websites. So this point, you guys understand that? If you have any question on this one, please let me know right now, then we will go over next step. Can you please check PKW? We will check the stocks. We'll check those two. Okay, so if this is understandable, let me see what he's asking. So can you explain a little bit more on the earning per share? Earning per share is, I believe it's a simple ratio. Whatever the market price is, and whatever the earning per share is, you divide them. So you will see what is the ratio. Okay. So in the next slides, yes, no, they will not give you the product like this, but you have to do manually. Somebody asked me if the stock screener can give you this product directly. No, you have to see the price to earning ratio, you have to see the price to book value, and then you multiply manually, and then you will see which stock you should actually invest in. So this is the basic fundamental. How do they calculate the price? How do they calculate the market price? Can you please help again navigating the? I'll coming back to the MSN Money again. So this is, we will be actually navigating to these website a couple of more times. So don't worry about that. Market price. So I'm coming to the market price now. How market price is set. So let's say when you go to this fruit market, who sets the market price? Yes. Who sets the market price? It's actually demand and sell ratio. Yes, consumer sets the market price. Who determine the market price to fruit? If the sellers are higher, more than buyer, if sellers are more than buyer, then it is a buyer market. So when it is a buyer market, you can assume the price will go down, because buyer will buy the things on their call, and seller has to sell it. So this is the buyer market. We often have seen that when the house prices is down, we say this is the buyer market. It means the prices are down, you can buy it at a lower price. So I'll do the PDF. And if the sellers are less than the buyer, then this is a seller market. It means you should expect the price will go up. So in the same way, this is the stock market. So market price are set by buyers or seller. It depends on who rule the market at that time. For example, when market is down, the stock market is down, so then it means it's a buyer market. So buyers are buying these stocks on the lower price. But when market is up, I'll do the PDF of this presentation. So just to understand how the market price is set, let's say ME is a seller. Yes, bull market and bear market is kind of same terminologies. When ME is ME is a seller of J&J stock, and stock, these are not the current price. So don't try to look at the website for these price. These are little older, for example. So no, there is no range for the book values, but as Warner Buffett suggested that the price to book value should be less than 1.5. So if Amy is selling a stock for J&J, she set a sell limit. This is important for the stock trading. So be conscious of this. We'll come back to the ratios again. So Amy want to sell her stock at 65. So she set a sell limit of the stock at 65. It means whenever somebody want to buy the stock at 65 or higher, then her stock, her share will be sold. On the other hand, the buyer set a buying value at 64. It means he set a limit that if a stock comes 64 or below 64, then he will buy. So in this case, nothing will happen. So price will be moving around. So how price will change? So she's asking 65 or above, and he want on 64 or below. What happened? An other buyer comes, he is in rush, he has some money, he just want to buy the share on the market price. And you have seen this in your, when you, if you guys are doing some stock trading or buying stocks, there is a market price buying option too. So if somebody come and say, okay, whatever the market price, I will buy. So he can buy the stock at 65. So price of stock will go to 65 automatically. And there is another lady who said he will buy the stock at a market price, so price will go to 65. So I repeat, if a seller sell to market price, the stock will go to 64 and he will buy. The market price of the stock will go to 64. And the next deal happens when a buyer comes and he want to buy at a market price. Market price, if 65, she put a limit, and she buy at 65, it means the stock market price will become 65. So that's how the stock price, market price is set. So these are the limits. So how to buy? If he actually sell for market price 64, and this is how the market price is set. She's thinking this stock stinks, I can make more money somewhere else. So that's why she want to sell it at 65. This money, this company is going to make me some money. That's why he want to buy. I need money for the car. This is just a sentiment of all the buyers and seller, and it can be different. These are just examples, and these are just sentiments. So market sentiment is you can change this behavior, but you can react to it. You can't actually stop people buying on a higher price, but you can react to it. You can understand the situation, and when you are doing the in stock trading, it should be emotionless. So what you're saying, if no one is interested to buying for the market price, then she will have to reduce the price. Can you please put mute? Somebody unmuted himself. So can you please mute? Yes. So market price, then she will reduce the price. Yes, if she needs money right away, then she might reduce the limit. But if not, then someone will come to buy it. The market will not stand alone. So if you have a price, it is not like nobody will come and buy it. Somebody will come to buy it, but it may take some time. So you need to be patient. So there are two type of patients. Some is saying, okay, buy the stock when it's going up, and sell the stock when it's going down. So this is the cycle of no. Somebody asked the question, does market price to buy means that it will be bought at lowest rate of the day? No, there is no direct relation for this. It depends. For example, if I'm waiting for to buy a stock at 65 and I'm expecting that price will come down from 70, and somebody is coming and he or she is buying at a market price of 70 or 69, I may not be able to buy, and I had to wait. And if I see that stock is going up and it will go further up, I may actually increase my limit to 68, 66, 67, and but it will hit, and I can tell you that it will hit. So you will be able to buy, but you need to be patient. So patience is the key in the stock market. Otherwise you will be actually caught up in the fear and greed cycles. So what is the fear? Any behavior. Fear is like, we all are thinking at this level, when stock is up, stock is going up, we are greedy. Oh, stock is going up, buy it, buy it, buy it. And if you recall, majority of us, majority of the stock traders, they buy when stock start going up. Is that correct? But this is a greed cycle. On the other hand, when stock is going down, what we do? We start selling even in the losses. So that is the fear cycle. So, but Warner Buffett what suggests that you need to do reverse, vice versa. If market is going up, don't buy. Wait until it's come down. So you have to wait. This is not the right time to buy, because immediately you will start losing. So, but what happens in the reality? When stocks are going up, you always think, oh, I should have bought this here, should have bought this here. But we became greedy. Yes, you're right. Warner Buffett says we can be when others were fearful, and we became fearful when others are greedy. That's the Warner Buffett suggests that we should do. When others are in greedy mode, you should be fearful. So that's what I'm saying. You should not buy here. You should be fearful that it will go down. So and here you need the patience. Be patient, don't do anything, wait until the market settle down. In the same way, when stocks are down, so what I have seen, the good traders, they actually top up their stocks. For example, if you have bought, uh, for example, if you have a CNRL stocks at $40 before 6 March, and now is trading around 20. Can you guys please mute? Someone has unmuted. So see who is unmuted. Okay. Yes. So normally, when, for example, the CNRA stocks at $40 and now it is being traded at $20, so what happens? The guys who fear, they will sell in the loss of $20. But the guys who has some investment in their pocket, now they have two options. Either hold the stock, it will come back, or if you have more money, you can buy a few more stocks at $20 and then sell when it goes higher. So normally people buy here at the lower end and sell at higher. But generally the day traders, they do reverse. They buy here, they sell here. That's why the day trading is always, most probably in 90% cases, is goes in loss. So someone is saying, I don't sell my stock and market goes down, then by just keeping my shares, will I lose money or not? It all depends how long you can hold your stock. For example, if you need money right away and your stocks are down, you probably have to sell them in loss. But if money's if you're okay to keep this money for a few more months, you can keep them. That's okay. And when it will come up, you can sell at that time. Some people are sharing some technical stuffs also, but we will discuss later on. So fear and greed cycle is short term. Anyone can set the price. If I'm buying at a higher price, I'm buying at a lower price. But in a long run, fundamentals play the key roles. Whatever the company worth, the stock will come to that one. So accumulation versus trading. So I would say investing versus trading. So value-based approach is if, for example, I really like, this is the sentiments which this investor has. I really like the company American Eagle, the company earning $2 per share. These are just I assume numbers, and the $18 of the book value is a great margin of safety. The 1% dividend is okay. Overall, I think the value is 22. Emotion-based approach, I like this. I don't care what company's financials are, but I see all my friends told me, or if I feel that this company will go up, then you actually buy or sell the stock. So these are two different approaches for the stock trading. So let's say I'm taking example now. Emmy has 100 shares for any company at $20. At the same time, Trevor also has 100 shares, each for $20. Now, when it comes down at the lower market end, the shares drop to $15. What these two guys will be thinking? Emmy thinks that although the company had a little less earning than I hoped this time, but $15 is a lower price, it better will come up. At the other end, the Trevor is thinking, oh no, what is the world did with this? So I'm losing some money, so I'm not going to buy anything else, so it may go further down. So what he is thinking. So Emmy bought more shares, 230, 133 more shares, but the Trevor is staying here. This is, keep in mind, this is kind of bottom. So Emmy actually topping up her stocks. So her average may come down from 20 to less. So average stock price will come down. She bought more, but he just stays same. When it goes up, Now she would sell because it's now up. Market price is 24, above the book value or the realistic value. So she sold the stocks here. But at this time, Travel, since he is emotion based, he will buy more. Oh, price is going up. I should buy more. I should buy more. So he would actually lose more money at the end. So what they have done, typical sound like Trevor. Now you choose yourself where you stand. Do you think like Trevor or do you think like Amy is in this example? So this is how the market price is being set by seller and buyer with the emotion based or value based. But at the end, you have a value and you will actually uh, checking your value from there. So now I'm coming back to the four pillars of Warner Buffett. So first rule, we already did talk about the fourth one, the undervalue stock, which is the price to earn ratio and price to the book value ratio. Now I'm talking about the first one, the vigilant stock, vigilant leadership. So we need to see which company has a good leadership and what leaders does in the company and how a stock investor, a shareholder, will check that. The depth, the debt are the important factor. And somebody asks again question, undervalue, how to determine the undervalue. So there is, yes, there is no fund the line that this is the undervalue or overvalue. It all depends on the market fluctuations. But if you actually keep those two ratios, which we already discussed, price per earning multiplied by price per book value ratio, it should be below 22.5. If it is below 22.5, it means this is undervalue. And if it is above 22.5, it means it's overvalued. So when it is overvalued, it means it will be coming down. The stock value will be coming down. So coming back to this point, so debt is the key factor to check how vigilant is the leadership. And there are a few terms how investors can check how good is the leadership. So number one, there are two ratios which will give us a picture how the leadership is behaving in that company. The one is debt to equity ratio, and second is current ratio. And I'm explaining them. I'll be going a little slow on these slides. So please focus on these ratios for now. And if you have any questions, you can just actually text me and we will discuss that. I'm going to the next slide. So we're talking debt to equity ratio. This is very important. How much debt a company has and how much equity a company has. For example, we have a company has a 20,000 debt and equity is 100,000. So it means its debt ratio is 0.2. Again, Warner Buffett suggests that debt to equity ratio should be less than 0.5. It means debt should not be more than 50% of their equity. So if you have a debt of 50,000 or 60,000 in this case, you have more than 50% debt on your equity. So this would not be good for that company. How to check that? If I go back to the ExxonMobil's MSN Money site, if I am here in the ratios, if I go further down, this is ExxonMobil. If I go further down, here you see 0.14 is the company's debt to equity ratio, which means they have 40% 40% debt as compared to their equity. So as per Warren Buffett recommendation, this is a good company to buy these stocks for now. What is 0.4? Okay. 0.4, the industry debt to equity ratio. So since ExxonMobil belongs to oil and gas industry, so you see the oil and gas industry has debt to equity ratio 0.54, but ExxonMobil has very good ratio in that. So let's see any other company. Let's see CNQ. I like that company. So again, I will go to the analysis, go to the ratios, and here I see right now and again, these ratios changes every month. So right now, the company's equity debt to equity ratio is 0.58, while industry still has 0.54, and they have debt to equity ratio 0.58 because of some loans they have. Say they bought some smaller companies. Yeah, I'm coming to the current ratio also. Somebody asked me that one too. So let's focus on the debt to equity ratio for now. So you can check. Below that, the showing current ratio. Are these ratios are direct ratio? Okay. How do you get to this page on MSN? I sent you the link. Otherwise, you can just actually, if you click the link I sent earlier, you guys can access this page. Please text me if you guys can access the page. Okay. So if you click, who is this guy? Tabish. If you click the link I sent you on the text box earlier, you will get to this page. That's easy. Everybody is getting there. I can send you a link again if you want. So you can click again. Okay, good. So this is the ratio which you can always check. And again, if you want to find someone debt to equity ratio, I believe it should be here too. So who has the debt to equity ratio? Popular. Market cap. I'm just checking. I never use that one here. No, you can't find here, but you can see on the MSN Money, and there are many other websites where you can check these stuffs. But I'm familiar with this MSN Money, so I use that because it has all the details here in one go, and it shows you the chart also. So debt to equity ratio. So right now we are in the CNRL. You see debt to equity ratio in December 11 was 3. Then it goes to a little higher. Now debt to equity ratio increased to this level as 0.58. So they were very lower, but if you see there is a big jump in debt to equity ratio is here. If you see the book value per share has jumped from this to this in 2018 somewhere. Is because of the acquisition of some companies. So that's how you see these. So other way around, there is another example where you have the debt to equity ratio is 1.6. So let's see this stock, VZ. VZ is probably VZ is Verizon. Yes. So Verizon. Debt to equity ratio. So it means they have more debt than equity. So this is risky company to invest right now. So that's how you can see these, because they have more debt. Anytime they will pay the debt, so you will lose your earnings and the price will go down. And again, I repeat, this is for long-term investment point of view. For short-term, if you are good in the stock technical analysis, then you may actually be able to make some money in short term. Now, first was the debt to equity ratio. Short term means I won't suggest you guys to do any day trading, because there are higher chances to lose your money. But swing trade, so it means it can go between a week to a couple of weeks when stock changes trends, so you can buy or sell at that time. So let's go to the second point. So I'm reading the question from Mr. Sayed. And DOL, like Dollarama, I can see the debt to equity ratio shows 1000. Can you explain? You are giving example less than 1, but here, okay, let's see DOL. So DOL. I don't know the history, what happened. I may not be able to tell you why this ratio is too high, but it is minus 1000. It means their equity, probably they are selling their equities, and they have more debt. So equity is a ratio between your asset and liabilities. It means they have more liabilities, so your equity is in negative. So let's see in the balance sheet. I haven't seen this before, but since you asked me the question, so let's see together. So total equity, see, the total equity for this company is right now in negative. So it means they have more liabilities than they have the assets. You see, their total assets are, let's say, 3.7 billion, and their total liabilities are total liability is not showing together because it's a current and non-current, but the net difference is minus. So that is the reason you see the negative 1000. Yes. So you can compare these with different companies, and then you can make your call. But these are good ratios to check. So next one is current ratio. So what is the current ratio? So in the balance sheet, whatever you see as current, so you see in the asset side, if you see the asset sides, there are current assets and there are current liabilities also. So any asset which will be converted into the asset, which will be actually realized within 12 months, this is called current asset. Any liability which you have to pay within 12 months, which is your salaries, the bills, everything, this is called your current liability. So this is also important to see how good is the company management is handling the company. So 12 months. So Warren Buffett suggests this ratio, the current ratio. It is called current ratio, which means current asset divided by current liabilities. So current ratio should be greater than 1.5. So here are definitions for the current liability I put here. So current liabilities are the liability which will be paid within 12 months. This is payroll and the overdraft expenses, and the current assets are the asset which company will be converted into cash flows within 12 months. Prepaid expenses, account receivable. So if you have account receivable, will be converted into your cash flow, these are your current asset, because since you don't have that cash in your hand, these are your asset. But once you receive the money, it will be in the cash flow and not in your asset anymore. So this ratio should be greater than 1.5. So let's see how ExxonMobil is doing. I'm taking the same example. So ExxonMobil, uh, if you see the current asset, I just pick from the money, msnmoney.com. So ExxonMobil, you can see in your balance sheet. In the balance sheet, it would show here are the current assets, and then you have the current liabilities. I put them together in this slide. So if you divide current asset by current liabilities, you will get this ratio. Yes, balance sheet is calculated once a year. So you will get this ratio. So Warren Buffett suggests if you have a ratio, current ratio greater than 1.5, this is good. But this is the question is how current liability is found in the daily basis for next 12 months. If you review the balance sheet, it will show you where the current liabilities actually adding up. So you have the payables, which bills, accrued amount, expenses, current debts, your loans which you will be paying within the 12 months. So that's how it's being calculated. Normally, financials do the forecast every year. So how much will be paying? For example, if you have a house and you have to forecast, you have to create your budget. So you will say, okay, for next 12 months, I will be paying 1,500 in a mortgage. So you multiply 15 by 12. So this is your current liability. You will be paying in next 12 months. So that's how financial team do these calculations. So I'm not going into detail how they are calculating, but this is good to know that how you use them. So you can generate the ratio, and the ratio is less than 1, and similarly the ratio is less than 1 for Verizon also. So, but just to understand that this ratio, if you have a ratio 1 more than 1.5, which is good. So more than 1.5 means you have current assets more than your liabilities. So which shows that your management is more vigilant, they are more focused. So you can expect that if they have more current assets and less liabilities, then you may expect increase in your earnings. Yes, current ratio is not good. That's why it's a combination of different ratios. So one ratio can go up, other can go down, and you can decide on the basis of the ratio. So you may not find one company which give you all the ratios good as per this suggestion of Warren Buffett. So you have to make your call. Sometime it may go other way around. Let's see what other companies are doing. Let's see DOL. We just opened, so I will check again. So if I go to financials, if I go to balance sheet, so current asset is 764 and current liability is this. So you can expect that this company will be either reducing your earning to zero or to very less. So that's what they're showing. So if you see now, if I go to the analysis and the ratios, so price per earning ratio is 23, current ratio, book value per share is -3. So this is very bad. So this company is not going good, and you can assume that its price may actually go further down. So this is not a good company right now to invest. So using these ratio, you can decide if company is a good to use. What about ETF? Somebody asked me what is the ratios for the ETF. So ETF does not fall in this because ETF is not a company. ETF actually belongs to multiple companies or industries. So ETF does not fall in these categories. So you cannot use the ratios for ETFs. ETF is how should I earn? I, I have to see the abbreviation, but ETF is the kind of stocks. For example, exchange transfer funds. Yes, some. Thank you, Bilal. Exchange transfer funds. So, for example, if you are not able to buy, you are not, you can't buy too many stocks of Apple or Google. They are too expensive. So some uh, big millionaire guys, they open a fund that belongs to Google, Apple, Facebook, and they say, okay, these are the shares we have for 10% from the Google, 10% from Apple, 10% from Facebook, and we create another stock share which may be $20 worth for you guys. So you will buy the $20, and actually you are getting a portion of shares from each stock. So ETF is not a company stock, but ETF is a combined fund created by some organization or group of people under the stock exchange governance. I'll come to that question. So this was the first rule. So you will note down that the debt ratios, two ratios, one the current ratio should be greater than 1.5 for a good company, and debt to equity ratio should be less than 0.5. So if I go to the second rule of Warren Buffett for long term, so what he said, you need to see, is there any rule of thumb that let me take the question. Is there any rule of thumb that we can use before buying the stock? Rule of thumb for what? Current ratio or for debt to equity ratio? Current ratio, the rule of thumb, I would stay close to what he's suggesting. You can agree or disagree with this, but I normally follow the rules what Warren Buffett uses. I would stay close to 1.5, not way out. But if I see like ExxonMobil is a good company right now, the market situation is bad. So the current market situation is different, and some of these ratio may not apply as realistically, because some companies are down which should not be, but because of the scenario, international scenario, they are down. So some of these ratio may not work as in this lecture we are discussing. What is D&E? Okay, depth and equity ratio. I think they can. Some screener, stock screener, they do give you option to sort the stock on the basis of debt and equity ratio and current ratio. I believe current ratio is already there. So let's see the ratios. And let's see the ratios. Current ratio should be here. You can check some other stock screener as well. There, when you do the Google, you may find many. So for example, this one, Let's see what they have. So no, this is something different. Okay. I think this is also a good one. Finviz. I have seen that one. They have a good information here. So you can always use this one also. But I'm not sure if they give some technical trending also. They give you what stocks are doing on the daily basis, who are the top gainer, losers. So you can do the assessment. I have to see. I'm not very familiar with all other stock screener, but you can explore this. I believe there would be some who can give you opportunity to filter these stocks through these ratios. So long-term perspective. So what Warren Buffett is suggesting that you need to look at which companies has long-term perspective. For example, there are few companies that you need to look at for long-term investment. I'm talking about. You need to look at the companies who has a solar energy or who has automations in the IT industry, biotechnologies. So these are the prospects. These are the ventures for future. So if you see these kind of companies or the IPOs, new companies forming up, so these are the good companies to check. And if you find some good company, these are good investment at that time. And from long-term aspects, these are just a tax calculation. If you keep the stock for long term, for example, if you are actually having a stock and your earnings are increasing from 1 to 20 years or 10 years to this level, and you actually encash all your earning after that time, so how much taxes you will be paying? You will be paying some taxes at once. Don't stick to the numbers. Each country, each area has a different numbers. But if you are actually taking stock and you are selling every month or 2 months and buying new stocks, so whatever you are earning at the end of the year, you will be paying tax. So you will be paying tax every year. So if you pay tax every year, at the end you will be paying more taxes. So if you hold the stock for longer period of time, you will be paying less taxes. And if you actually sell by in the short terms, you may be paying more taxes. So there is no rule how long you need to keep the stock, but you need to keep in mind that whatever you are selling, you will be paying taxes for that. This is for long-term perspective. And last third rule which we will be discussing here is stock stability. So if you see equity chart. So for example, if I go back and if I open the ratios, I'm just checking where the equity uh, rates are. So even if you check the debt to equity ratio, if it goes with a consistent line, it shows you the trend. But if you, for example, if we go back to ExxonMobil again, you will find debt to equity ratio. It goes very in a smooth way in the upward direction. So it means the consistency is there. But if you find some companies, I don't remember one, but let me try if they have a different chart. Going back to the analysis. So if you see the debt to equity ratio is going up, going down. So it means their management is not very consistent, or there is a big change in the management here. So this kind of companies are risky for long-term investment. So that's what we are talking here. So stability and predictability, where you can see, okay, this will go in the right direction. So one example is this one, and one example is this one. So which one is better for you, this one or this one? So definitely you have more predictability in this company that is showing you a consistent graph. But here you see the ups and down roller coaster. It means they are not predictable. They can actually increase your profit anytime. They can kill your profit anytime. So that's you also have to see. There is no ratio for that. It's just actually you have to do your analysis how is doing as a management perspective. So one is very risky to predict and other is less risky to predict. We know that where it will be going, we see the trend. Yes, I have a couple of examples here for Cirrus, Radio, Siri, and for Disney World. So Disney World was going very smooth in between 2 to 21 11, but at the same time the Siri was going up and down. So one is risky and one is not. So you have to check which company is giving you more predictability to flow. So this is what 4 rules Warren Buffett have, which we need to see. I will be sharing this the rules in a summary one sheet with you guys, and I will also be sharing one goodwill presentation video to you guys to understand how to assess the goodwill of a company. And next is rate of return. So you have to you would look at what would be the rate of return for a share you are buying. For example, if a company you are buying for $10, you are buying the shares for $10, and the company's stock may go to 15 in next 1 year or few months. So you will be getting 50% profit on that stock. On the other hand, if you are buying a stock for $100 and $100 stock, after 1 year or after a few months, it may go to $5 up. So you are getting the gain of $5. So when you are buying these stocks, you need to also calculate how much you are investing, how much money you have in your hand. For example, if you have 1,000 and one company has a stock price of $10, and you are assuming that it may go up to $12, which is $2 per share, which is 20%. And another company is like $20, and you would be able to buy 500 stock with $10,000. Then and the company goes the stock goes to from 20 to 30, so you will be getting $10 per stock multiplied by 500, so you would be having $5,000 in your pocket. So you need to calculate your assessment how up the stock can go and how much money you can make. This is your rate on your equity, how much money you will be making after the investment. So this is what I have for today for all these. So I will be sharing this PDF with you guys. So if you have more question on these ratios and these stocks, so you let me know, and we can discuss that. If you have questions, you can ask me questions right now. We can discuss that. Please, can you explain how I start the account? which stock account you're talking about. So if you have if you have a if you don't have the investment account, so here's general suggestion from my side. So again, uh, these are suggestions. There is no final word from anyone, but what I'm suggesting, if you guys have RRSP and your RRSP is staying with the financial companies, so you can always actually talk to your banks. Bank has a stock trading account for RRSP, so you can transfer your money directly from financial institute to your bank in the RSP account directly, and you can trade, you can buy stocks in your RSP by yourself. You can buy the stock and you can sell the stock in the RRSP account. So when you talk to your bank, you can tell them you want to do the stock trading by yourself. So they would actually be able to create your stock account, and then you would be able to transfer money from your current account to your stock account, and then you can actually do trading. I can show you uh, I can show you some TD is a good bank. I like that. Their trading platform is very good. I don't have any other experience with CIBC, RBC. They might also be good, but you can check the guys who are already using it. I don't have any experience. So TFSA, direct trading account, you can open the TFSA also. So for these account opening, you need to talk to your bank. They will give you they will open account for you as a direct trading account. So you can buy and sell the account directly from your system. Questsite.com is also good. Someone is suggesting you can explore that one too. Yes, somebody asked me, can Canadian buy US stocks? Yes, US stock, if you're Canadian from any bank, you can buy stocks. You can trade stock in the Toronto Exchange and the New York Exchange, both. So all the American exchange, all the Canadian exchange, you can do simultaneously. So there is no differential. Any other questions from you guys? I'll try to schedule some technical analysis webinars also for the stock trading. So you can see that will actually show you. Uh, there is one more thing which I should be discussing if I have that here. I think I have it here. One more thing. Okay, stock volume. Okay, yes, that is important also. What happens? Whenever you are buying or selling the stock, you also need to keep an eye on the stock volume. I'll try to do advanced course on the technical side also. So let me plan and schedule it as soon as possible. My plan is I will be actually doing many webinars uh, from different from management side, from personality development side, from stock trading side. I already have added you guys in my distribution list, but you will have option to unsubscribe. It's very easy. There would be a button at the bottom to unsubscribe. You can do unsubscribe. But for now, you are in the distribution list. So whatever the webinars I will be scheduling, I will be sharing with you. Tomorrow we have another webinar for the cyber security. Lot of parents, they have concerns how to manage their cyber security, internet security at home while their kids are also working. How they can manage to control their kids' activities on the internet. So I requested one expert. I'm not expert in that, so I have requested one expert who will be doing the webinar tomorrow. Uh, that webinar will be 2 sessions. One will be tomorrow for one. I'll share those that cyber webinar linked to with all of you guys. It is free, and it would be actually same time, 10 a.m. Calgary time. So you guys can register. So one session will be tomorrow for around 1.5 hours, and another session will be on 26th of April uh, with more details how the parents can control the internet activities of their kids. So meanwhile, I'll be sorting out what kind of webinars I can conduct, and I will let you guys know. So come back to the last topic on this webinar today, the stock volume. The stock volume is very important. So I will be going quickly. If from any trading account, you can see how much stocks has been traded on that particular day. So if you let's say there is one dot in this whole picture as a 10 million shares. We are talking about billions of shares for any one company. So the volume traded in the New York Stock Exchange, generally the company's volume is above 5 million trades or shares per day. So just keep in mind that's a big market. So what happens in the volume? Some guy come and buy and sell the shares, but it's not whole market. But when you see a big volume jump in to doing either buying or selling the stock, it means there is something big is happening. I pick an example here. On 2nd March 2019, the market was crashed. 1.1 billion shares, the highest volume in 10 years, were being done. Market price for one share was 7. Book value was this. EPC and these ratios were there, and this suddenly down. If you see a big volume is happening, it means there is a major event is happening. If you see on 6th of March trading, you can go and check how much volume has been done traded on that particular day. That shows you the big event is happening. So whenever you're trading, don't go with the price only, just look at the volume also. How many guys are trading? And some of the platforms in the stock trading, they show you either it is going the volume is being on the buyer side or the seller side. So it will give you indication where the price is going. So I think when I will do the technical webinar, the smaller ones, so I'll show you how to see the volumes on the tradings. But there are different websites you can go and check. For example, if I go here in the ca.investing, if I see, I have some portfolio built up here. So for example, it shows you this is my portfolio. You can create your own portfolio. You can create the tabs here. You can add these stocks here. For example, if I have to add any stock, like let's say Dollarama, if I'm adding here, I will search the DOL. DOL is in the when I click, it will show up here. So if I want to add or I want to remove, this is my portfolio. If I have to see some stocks, how they are trading, I can always go and check. And if I click any stock like Imperial, it will open up a chart here. And when I click to this one, when I click to the technical one and it window becomes like this, if I open this here, and the bigger window, you see there are some bars. Generally, I love to see the charts like this. So it shows you how it being done, and it shows you at the bottom. If you see here, can you see my screen? If you see, the volumes are here. It shows you Imperial Oil's volume. So I can zoom in by moving the mouse wheel. So if you see the how big is the volume here? So how many guys has 2.3 million shares in one day? So you can change the time frame from here. So this is one example. There are many more. For example, this also has some good charts options. It gives some good information. And there is one more website which I think I'll share the link with you guys in the chart box, so you can use that one. And there is one more thing, one more website which is very good. I normally use it, uh, Stock Tweet. This is also good. Uh, this is not something very. Generally, people come and do their comments here. It is not. It is not through any company. But if you see CNQ, if I open this one here, no, I have to. Oh, CNQ here, CNQ stock. So what you see here, the pupils' response. So I don't follow the sentiments of people. They are commenting here, because these are the guys just like you and me. So I don't trust them 100%. But what happens when I go there? The benefit is, if there is something big happening, you may find the news here. Okay, what happens? So what has been done? So that is the only purpose I'm using this sometime, but I don't actually go and rely on the comments the people are giving there, because that's their own comments. And these guys are just like you and me. So this is what I have for today. The final checks, I will send you this. So these are 5 points which we have discussed. You should look at the companies which has more than $500 million market cap, PE ratio, price to earning ratio less than 15, price to book value less than 1.5, current ratio greater than 1.5, debt and equity should be less than 0.5. This is just a thumb rule, but numbers can vary between these, and you have to make your call if this company looks good to me. And these, for example, CNRL has, for me, CNRL is very good company, and I like their leadership style. And IPL from Canadian side, Interpipeline, also has a good perspective. So if somebody asks me in these times which companies the stocks need to buy, I would actually be more inclined toward the CNRL, IPL, and Imperial. But there are other companies also which shows you which company stock is from oil company, from IT companies. You may need to find some good companies you should find. For IPL, I personally believe this is a good progressive company. But again, I haven't done the complete analysis. This is my feeling, not on the basis of fundamentals. I'll check that one too. For the investing or trading point of view, you think IPL is still good? Mr. Sheikh, what you are saying, can you put there here in the text what I need to put here? Um, I would actually let's say CNQ is the ticker, IPL is the ticker, and EMO is the ticker. I can show you my screen in my portfolio. These are the companies which I normally follow. So even the Baytax is also a good buy right now because these are in pennies, but need to check the fundamentals for this one also. Suncor is very good company. Suncor is almost similar like CNRL. Then for for the metals, if you see the gold and silver, there are few companies also which you guys can check, like Camco, and Camco is CCO, CCJ, and there is no the endless list of the companies. So tech companies, Biotricity, Snaps. So there are lithium companies are also very good. So if you see in my metals, so I'm following the lithium also. I should have somewhere lithium here too. Uranium, lithium, these are the metals. So in these charts, you can also see some fundamentals about the companies. You can go into details, but these are just ideas. You have many more websites, platforms. You can use whatever you want to use, whichever is comfortable, fit for your needs. You can do that. So, for example, in this uh, general rule of thumb, if a company goes down, I would start keeping an eye on that one, because if it is going down, it will come back too. But I have to see uh, why it goes down. For example, there is a company, I believe it's KL. There is a lawsuit on this company, and once it is resolved, this company goes down from 20 to $4 just because of lawsuit. So I'm just keeping an eye what happened to their lawsuit, and if it comes, it will come back to the price. But don't take these numbers as my advice. I'm just actually throwing numbers as coming into my mind, but you need to do your own analysis before you start investing on these. So that's all I have for today. I'll send you the PDF, and I will send you some more basics. I will send you some. I'll send you a video also, which shows a video shows how to evaluate the company's goodwill. So I will send you that videos to you guys too, and you can work on whenever you have a question. You have my email. You can always let me know. I'll send you the cybersecurity. Um, in fact, wait for a second. I can send you link right now. If I go here, in fact, I'm stop sharing, and I will send you the meeting link right here. You guys can copy and you guys can use it. I'm just trying to open the link for that meeting. I think I'm feeling challenging to copy that one, but I'll send you the link for cybersecurity, so you can, if you want to join, you guys can join. And if you don't have any other question, then I think that's it for today. If you have any questions, please let me know. I'll answer. If you can always approach me even after that too. thank you very much for your time, and I appreciate you being here. I'll keep you in the loop for my upcoming webinars. I think I will be doing another webinar for rediscovering yourself. This is the this program I'm just typing rediscovering yourself. This is the self-development program. I'll be doing the webinar for this one. I'll be doing webinar for 7 habits of highly effective people. I have my YouTube channel as Winning Edge, where my objective is to motivate people. You can follow you can look at the page if you want to, not necessarily, but my objective is to help people, especially in our native language. So I will be doing this in Urdu or Hindi for my native fellows, to motivate them. For example, like 7 habits of highly effective people, I will be doing in English and in Urdu also in a separate version. So you can always invite your family members too. So Winning Edge. This is the web page for that one. And thank you very much again. I really appreciate you being here. It's a weekend and you guys wake up early. Be
Thank you,
safe.
Haider bhai.
Yeah, be safe, and be active. I would suggest everyone to do some exercise, even at home. I used to do in different my different health groups. I have some health and diet groups too. In the health groups, I have a competition for exercise daily, plus for controlling the diets, and to show what exercise you have done to motivate others too, because this is the time we all need to help each other, to support each other. Sitting home eating food is not good. We need to do some exercise. I would suggest to do some walks also, and that's all I would be suggesting. Thank you very much, and stay tuned for my other webinars coming up. Thank you. I'll be actually logging off now. Thanks, everyone. I'll be sending you the PDFs and everything. Thanks.